Imagine a company announcing this to its shareholders. We've decided to move the majority of our capital into assets that feel stable, familiar, and unlikely to fluctuate. The priority is safety. Returns are secondary. No board would frame it that way publicly, but if they did, analysts would immediately ask a different question. Safe relative to what risk and over what time horizon? Because in capital allocation, safe is not a property, it's a relationship between cash flows, liabilities, and time. That same question applies to personal wealth, what people often call safe money, cash savings, low-yield deposits, capital parked primarily to avoid volatility, is usually treated as a moral decision rather than a balance sheet one. The assumption is that safety means protection. The problem is that protection from one category of risk can quietly increase exposure to several others. From a forensic perspective, cash-heavy positions are not neutral. They have a return profile, a risk profile, and second-order consequences. They are assets with behavior, not placeholders. And once you model them that way, the danger isn't that they fluctuate, it's that they don't respond when conditions change. At the corporate level, excess idle cash is often defended as prudence. It provides liquidity, optionality, and insulation from shocks. Those are real benefits, but they do not exist in isolation. Holding capital in instruments with minimal yield introduces opportunity cost, the return you give up by not allocating elsewhere, and that cost compounds quietly. Over multi-year periods, even modest inflation or currency erosion can shift purchasing power enough to materially change future decisions. This is not an argument against liquidity. Liquidity has value. The issue is mispricing that value. When investors overpay for liquidity by accepting near-zero real returns for long periods, they're effectively purchasing insurance without checking the premium relative to the coverage. Consider a simplified scenario. Two households with similar income and spending profiles both prioritize safety. One holds a large cash buffer well beyond emergency needs. The other holds a smaller buffer and allocates the remainder into assets with variable returns but higher expected long-term yield. Neither household experiences catastrophe, no dramatic failure occurs, yet over 10 to 15 years, the divergence in optionality becomes clear. One has flexibility, choices about work, relocation, or absorbing shocks. The other preserved nominal safety but narrowed future paths. This is where human behavior enters the system. People tend to evaluate safety emotionally, not probabilistically. Volatility is visible. Erosion is subtle. A 15% drawdown triggers action. A 2 to 4% annual loss of purchasing power rarely does, even though its cumulative effect can be larger. That asymmetry leads to decisions optimized for comfort rather than resilience. There is also a timing dimension that often gets ignored. Cash feels safest when income is stable, but income stability is itself probabilistic. In periods of disruption, layoffs, health issues, industry shifts, capital is not just a store of value, it becomes a decision engine. Assets that failed to grow during stable periods can force harder choices during unstable ones, not because they are unsafe, but because they were underutilized when time was on your side. To be clear, there are contexts where holding significant safe money is rational. Near-term liabilities, known expenditures, transitional phases where optionality outweighs growth. Institutions do this deliberately. The mistake is treating that structure as a permanent default rather than a situational tool. When analysts review a company with excessive low-yield reserves, they don't accuse it of irresponsibility. They question capital efficiency. They ask whether the balance sheet reflects realistic risks or inherited habits. The same lens applies here. Safety is not the absence of movement, it's the ability to absorb stress without being forced into bad decisions. Another risk often overlooked is concentration, not in assets, but in outcomes. When a large share of wealth is parked in instruments designed primarily to preserve nominal value, the future becomes unusually sensitive to a narrow set of variables: inflation policy, currency strength, and interest rate regimes. None of these are directly controllable, and all of them operate at the system level. This is where second-order effects matter. Low-yield safe capital doesn't just fail to grow, it subtly changes behavior. People delay reallocating because doing so would acknowledge that prior assumptions may no longer hold. They become reactive instead of adaptive. The capital stops functioning as a buffer and starts functioning as an anchor. There is also a structural mismatch that mirrors a common corporate error. Many individuals hold long-duration goals, retirement, education funding, future flexibility, but fund them with short-duration instruments. Cash and cash equivalents are optimized for immediacy, not longevity. Using them for long-term objectives introduces reinvestment risk, the risk that future returns available on safe instruments will be insufficient when needed. In corporate finance, this is treated seriously. A company funding long-term projects with short-term debt is exposed to rollover risk. The personal equivalent is funding a decades-long purchasing power requirement with assets that reset their returns every year at prevailing conditions. That structure assumes favorable conditions will persist or reappear on schedule. Sometimes they do, sometimes they don't. A common counterargument is that safety provides psychological stability, which has real value. That's true. Financial stress can degrade decision-making, and liquidity reduces that stress. The issue is not the benefit, but the trade-off. Psychological comfort purchased through excessive conservatism can create a false sense of control, encouraging people to ignore structural fragilities until they become unavoidable. Another argument is that markets are unpredictable, and avoiding risk is rational. Markets are indeed uncertain, but uncertainty does not disappear when capital is idle. It shifts form. Market risk is noisy and visible. Policy risk, inflation risk, and opportunity risk are quieter but persistent. Avoiding one category does not eliminate uncertainty. It concentrates it elsewhere. A realistic scenario helps clarify this. Imagine an individual with a stable professional income who prioritizes safety by holding most savings in low-yield accounts. For years, this works fine. Then an income disruption occurs, not catastrophic but prolonged. Because capital growth was minimal during the stable years, the individual faces a compressed decision window: accept inferior work, liquidate assets at an unfavorable time, or materially reduce living standards. None of these outcomes are caused by recklessness. They emerge from a structure optimized for calm periods, not transitions. This is where opportunity cost becomes tangible. Opportunity cost is not an abstract number, it's foregone flexibility. It's the difference between choosing and being forced. When returns are consistently below the rate at which future obligations grow, the gap doesn't announce itself, it accumulates. Importantly, this does not imply that higher-risk assets are inherently superior. Risk without structure is fragility. The point is alignment. Capital should be matched to time horizons, liquidity needs, and human behavior patterns. Systems that rely on perfect discipline or constant optimism tend to fail under stress. When safe money works well, it's usually because it's deliberately bounded. It covers known liabilities, buffers uncertainty, and buys time, not indefinitely, but long enough for other parts of the system to function. In those cases, safety is a role, not an identity. It coexists with growth assets, diversification, and periodic reassessment. Problems arise when safety becomes the default setting rather than a parameter, when the absence of volatility is mistaken for the absence of risk, when capital allocation decisions are inherited from social narratives rather than designed for specific constraints. Analysts don't ask whether a balance sheet feels safe. They ask whether it's robust under multiple scenarios. That same question applies here. At this point, the discussion becomes less about assets and more about architecture. Wealth is not a pile of instruments, it's a system that converts time, income, and uncertainty into future choices. Systems fail not because one component is flawed, but because components interact in ways that were never stress-tested. One of the more subtle failures of excessive, safe allocation is path dependency. Early decisions constrain later options. Capital that underperforms for long periods narrows the margin for error, which in turn increases sensitivity to timing. When growth becomes compressed into a shorter window later in life or later in a plan, the tolerance for volatility often decreases, precisely when volatility may be unavoidable. This creates a paradox. The attempt to minimize risk early can increase exposure to risk later when recovery capacity is lower. Not because markets are punitive, but because time is asymmetric. Losses in optionality are harder to recover than temporary price declines. Human behavior amplifies this effect. People anchor to nominal balances. Seeing a number that doesn't go down feels reassuring, even if its real purchasing power is deteriorating. This anchoring can delay necessary adjustments. When change finally occurs, it often does so under pressure, not choice. From a systems perspective, this is similar to organizations that defer maintenance to preserve short-term stability, only to face larger failures later. Nothing breaks immediately, the system just becomes brittle. It's also important to recognize that not all risk is symmetrical. Volatility is reversible, time is not. A portfolio that fluctuates but has a positive expected return can recover given enough time. A portfolio that consistently fails to outpace obligations cannot recover lost time without increased contributions or increased risk later. That asymmetry is central to why safe money can be dangerous when misapplied. None of this invalidates the legitimate role of conservative assets. They provide liquidity, reduce forced selling, and stabilize behavior. In fact, portfolios often fail not because they were too conservative, but because conservatism was applied indiscriminately. Safety was layered everywhere rather than concentrated where it mattered most. When conservative assets are structured intentionally, sized to realistic stress scenarios, integrated with growth assets, and revisited as conditions change, they enhance resilience. They absorb shocks so that other assets don't have to be liquidated at inopportune times. In that context, safety is functional, not performative. The danger arises when safety is treated as a universal solution rather than a targeted tool, when people conflate the absence of visible risk with the presence of durability. Durability comes from diversification across time horizons, return drivers, and behavioral constraints. This brings the discussion back to capital allocation. Every dollar is a vote for a certain future probability distribution. Some votes reduce volatility today at the cost of increased dependency tomorrow. Others accept variability in exchange for adaptability. Neither is morally superior. They are trade-offs. A useful lens, then, is not, is this safe, but what risk does this introduce, and when does that risk become binding? Liquidity risk, inflation risk, reinvestment risk, behavioral risk. These are not eliminated by holding cash, they are reshaped. In the end, the most dangerous assumption is that a familiar structure is a neutral one. Capital left unexamined still exerts force. The question is whether that force is aligned with the realities it will eventually face. If you step back far enough, the issue resolves into a decision framework rather than a prescription. Every allocation choice embeds assumptions about time, stability, and human response under stress. Safe money is not dangerous because it exists, but because its risks are often unmodeled. A resilient structure starts by separating functions. Liquidity is there to prevent forced decisions. Stability is there to smooth behavior. Growth is there to preserve future purchasing power. Problems emerge when one instrument is asked to perform all three roles simultaneously. Cash is excellent at the first, acceptable at the second, and structurally weak at the third. Expecting otherwise is not conservative, it's a category error. From a balance sheet perspective, it's useful to think in terms of mismatches. Mismatch between asset duration and liability duration, between visible risk and invisible risk, between how capital behaves in calm environments versus transitional ones. These mismatches don't announce themselves as mistakes, they surface later as constraints. This is why analysts rarely debate whether a decision is good or bad in isolation. They ask whether it is coherent within a system. A large cash position can be coherent when it's sized to known risks and paired with assets that address unknown ones. The same position can be fragile when it becomes a default driven by discomfort with uncertainty rather than analysis of exposure. None of this requires forecasting markets or predicting policy outcomes. It requires mapping dependencies. What happens if income pauses, if inflation runs higher than expected, if opportunities appear when capital has not grown? The goal is not certainty, but preparedness across a range of plausible scenarios. Viewed this way, the real danger is not volatility or conservatism, but unexamined assumptions. Money that feels safe because it doesn't move can still move you closer to a corner you didn't intend to occupy. And once you see wealth as a system rather than a statement, safety stops being a label and becomes a question of alignment.